I think we are at the tail end of a more than 40 years asset inflation period, which began essentially in 1982 for stocks at the August low on the Dow Jones. We were at 780. And in 81, we had the peak in interest rates in the United States when 10 years treasuries were yielding more than 15%. And since then, asset prices have gone up a lot. We also had consumer price inflation, but not as much as asset inflation. But lately, things have changed somewhat in the sense that asset prices are no longer universally going up. We had some serious setback in asset prices. As an example, US commercial real estate. That was a safe investment for a long period of time. And nobody, I don't know anyone who predicted that commercial properties in America would collapse by as much as they have collapsed in the last 4 years. I mean, I've seen properties in Los Angeles, they were worth 100 million. Now you can't sell them for 20 million. The problem with monetary inflation, and we live in a monetary inflationary period, is that the price level in the economy does not go up regularly and universally, but you have something that goes up strongly and something else that goes down, and then it changes. So as an example, in 2023, the price of cocoa went ballistic. This year, coffee is up 84%. So, and that is the danger of this monetary inflation. And the central banks, they don't know either where the liquidity goes to and where it creates an asset bubble and where it creates an asset deflation. So my view for investors would be to be very careful, because there will be a lot of volatility going forward with asset prices, some going up a lot and some going down a lot. I mean, I'm very negative about the Magnificent Seven and the FANG-related stocks and semiconductor stocks, which are very popular. On the other hand, I'm very kind of interested in the assets of China and Hong Kong. I got my name, Dr. Doom, in Hong Kong because I was always very negative about Hong Kong, especially after the handover in 1997. But now Hong Kong assets are very cheap, and I would be a buyer of Hong Kong assets at the present time. I think they have an upside potential of, say, stocks, 50, 100% quite easily. If I measure the rest of the world, Europe, Latin America, Asia, relative to the US, the gap in valuation is as wide as it's ever been. So I would buy cheap assets and avoid expensive assets. There's always a risk. If something happens in the South China Sea, Great Lakes District will be immune to an attack by America on China or conflict between Taiwan and China. So I'm just telling you, in my view, the Chinese market would, of course, be hurt, but I suppose that American stocks and European stocks would also be hurt very badly. In general, I would be light on financial assets. I mean, if you look at the world and then you take the financial market, for most of human history or capitalistic history, the financial market was actually smaller than the real world. GDP, say, in the 1970s, the US stock market capitalization as a percent of the economy was between 20 and 30%. Now we're up at 160% or something like this. So the financial market in the world has expanded much more than the real economy. And in particular, government debt as a percent of the economy has ballooned. So I see there a gigantic financial bubble, the biggest financial bubble in history since the 14th century. We are now in the midst, and that one day will be deflated very badly. I'm afraid that I have a low opinion of politicians, and there's always a lot of talk and little action. In my view, say, when it comes to cutting down the government inefficiencies, it will be extremely difficult. And if they want to cut spending out of the entire budget in the US, there's very few items they can really cut, because a lot of expensive programs must be paid, like Veterans Administration, Social Security. You cannot cut Social Security. You cannot cut Medicare. So the scope of reducing government expenditures is very small. Plus, I know people from the private sector, they went to government companies like the post office. After a brief period of time, they resigned. You can't fire everybody because there are labor contracts, and to cut the inefficiencies drove them nuts. Drove them crazy. But if someone believes that increased government spending boosts economic activity, he must believe that reduced government spending would hurt the economy, at least temporarily. I think in the long run, less government would be good. But in a democracy, to have less government is very difficult. Maybe I'm too pessimistic, but I think that the euphoria that we are seeing now would be more positive if it occurred amidst low valuations in the market. And after a bear market of, say, a few years, where suddenly stocks become inexpensive, and then there is a turnaround in the political system, and then stocks shoot up, like this was the case when Milei became president in Argentina. But it's not the case at the present time. At the present time, this euphoria follows a bull market that began on March 6, 2009, and was accompanied by huge fiscal deficits, money printing without an end, and simultaneously at the present time, record valuations. Valuations are not low. I concede that some stocks, oil shares and mining stocks, are depressed, but by and large, financial assets are in the sky. If you print money, everything will go up, including inflation and interest rates. The Fed is in a difficult position. They can print money, yes, but will anything go up in real terms, inflation adjusted? That is the criteria. Government says the economy is growing, GDP up 3%, 2%, whatever. The reality is that most people in America, over 70%, live paycheck to paycheck. In other words, they have to wait to get their salary to pay the interest on their debts, to pay the car loans, and then some government officials tells me the US economy and the consumer are in great shape. Nonsense! The statistics are completely distorted. Bureau of Labor Statistics says that healthcare costs dropped something like 30% in the last 3 years. I've seen letters from insurance companies to insured people where the premium increases are outlined in 3 years, 99%. If you look at the market, the liquidity aspect is the most important. But when companies report bad earnings, the stocks really react negatively on the downside. In my view, the day people will recognize that the economy is not doing so well and earnings begin to disappoint, and it doesn't take much for Nvidia to disappoint because the expectations are so high. I'm trying to explain to you that the valuations are at the record, and consumer confidence that stocks continue to go up are at the record high. So a minor disappointment can have a huge impact on the level of stock prices. Well, the ego of politicians is a huge bubble. Most of them are completely incompetent, and most of them have never worked in the private sector. But then they go and they tell the private sector, you have to do this and you have to do that, and we have new regulations here. In other words, they introduce regulations in fields, in sectors about which they have no clue. The most blatant example of incompetence and arrogance is the COVID case. They didn't even allow people to express concerns about COVID. It was banned. The only question is, from here on, do we move more to the left? And is Trump just a roadblock that will be overcome in 4 years' time? Or can he reverse and move the country and the system more to the right? But either way, in my view, we will have a more authoritarian government. I mean, the most cruel period in history was the Bolshevik Revolution. Maybe that is what America needs. I have the same expectations I had for the last 30 years. I think gold and silver will maintain their purchasing power. Say, if I bought an ounce of gold at $35 in 1970, we are 2,700. So if for the last 70 years, I went to jail and I come out of jail and had all my money in gold, the money I deposited has kept its purchasing power. I can say this. And I suppose some people say gold is cheap and some people say it's expensive. In monetary inflation, that I want to stress, everything becomes murky, opaque. You can't tell is something expensive or cheap. Very difficult. But you can compare, say, this item against that item against this. And then you can say, this is relatively cheap compared to this, and this is relatively expensive compared to this. So we can establish the relationships. One relationship I can establish, I take all the financial assets in the world, the stock market capitalization, the lending activity by banks, and the bond market, and then I compare it to the quantity of gold, say, that is above the ground. At the present time, the quantity of gold within the monetary system is relatively small by historical standards. Gold is relatively expensive compared to the price of wheat, corn, and soybeans. Or I can take the price of gold and say it's relatively expensive compared to a barrel of oil. So we can establish all sorts of relationships. I hold gold because it's difficult for me to store 5 tons of wheat. And it's difficult for me to store 100 tons of oil. So I own gold physical. And within the gold space, you can compare it to silver and platinum. Platinum is the cheapest, very inexpensive at the present time. And I'm very optimistic for platinum in the next, say, 5 years. I can also compare gold and other financial assets to gold shares, mining stocks. Mining stocks are very cheap relative to everything else. So as an investor, you can invest some money in mining stocks if you want to invest in depressed issues. Or you can invest in China or Hong Kong or in emerging markets and some European markets. So that's what I would do. What other people do is their business. You understand? Everyone has a different investment objective. Every year, some commodities will run away more than others. 2023, the price of cocoa. 2024, maybe people notice it when they go and buy the coffee for breakfast. The coffee price is up 84%. And some commodities have gone down and some have moved sideways. I would diversify because, as I said, we don't know. And I would hold some cash. I would hold some real estate. Some real estate stocks have performed very poorly and are now bottoming out, especially as I mentioned in Hong Kong and China and Asia in general. And I would also own some precious metals, as I mentioned, and maybe some physical real estate. And then you have to choose. I'm not so optimistic about major cities, but you can buy in Europe land in the countryside or houses in small villages, essentially for free. You have to redo it, and it would be helpful if you have some manual talent that you wouldn't have acquired at the socialist universities where socialist professors teach nonsense like all kinds of political sciences.